Everyone loves a fat dividend. 10%, 12%, 13%. Sounds like easy money, but here's the problem. Yield isn't the full story. Some ETFs look incredible on the surface but destroy your long-term growth. Others look boring and end up building a fortune. So here's the question. If you had $100,000 to invest today, would you put it in SPYI, QQQI, or OMAH? In this video, I'm putting these three popular monthly high-dividend ETFs to the test to see which one actually wins. I'll break down how each one truly performs, how much they pay, how fast they grow, how risky they are, and what type of return you can expect if you invest a one-time sum of $100,000 into these ETFs over the next 1, 5, and 10 years. And in the end, I'll show you a winner that can potentially turn this $100,000 into a $500,000 portfolio that pays over $2,800 in monthly dividend income. Before we jump into the results and start running the numbers, let's take a closer look at the three ETFs we're comparing, each with a strong focus on monthly income, but each one takes a very different route to get there. Let's start with SPYI, the NEOS S&P 500 High Income ETF. This one's built around the S&P 500, which includes 500 of America's biggest, most established companies – Apple, JP Morgan, Johnson & Johnson, you name it. SPYI takes those stocks and adds an options overlay, specifically by selling covered calls on the S&P 500 index itself. That move creates extra income from option premiums, which is why its yield looks so high compared to a regular S&P 500 fund. There's a trade-off, though. Because of those call options, SPYI gives up some upside when the market rallies big. But here's the part that many investors love. Its distributions are tax-efficient, with a good chunk classified as return of capital, or ROC. In simple terms, that means you might keep more of what you earn after taxes. SPYI is all about consistent, diversified, and tax-smart income, a mix that appeals to investors who like balance and predictability. Next up, we've got QQQI, the NEOS Nasdaq 100 High Income ETF. It uses a similar idea, a covered call strategy, but applies it to the Nasdaq 100, the index loaded with the biggest tech powerhouses like Microsoft, Nvidia, Meta, and Apple. Because tech stocks tend to move faster, QQQI can swing a little more in price, but that also gives it a bigger compounding potential. What makes QQQI interesting is that it doesn't just sell calls, it can also buy call options when the data suggests it's a smart move. That flexibility helps capture more upside during bullish markets. Like SPYI, most of its income comes from option premiums rather than traditional stock dividends, and it also benefits from the Section 1256 tax treatment, which can make its monthly payouts more efficient come tax time. And finally, we've got OMAH, the VistaShares Target 15 Berkshire Select Income ETF. This one takes a Buffett-inspired approach, focusing on owning around 70 high-quality dividend-paying companies that mirror the core of Berkshire Hathaway's investment philosophy. But here's the part that surprises people. OMAH also uses a covered call overlay, just like SPYI and QQQI. The difference is that it does so more conservatively, pairing its core equity sleeve of strong, value-driven businesses with a thoughtful option strategy to boost monthly income. That combination gives OMAH the best of both worlds: durable, dividend-focused companies generating steady cash flow, plus option premiums that lift income without taking wild risks. All three ETFs are designed to deliver consistent monthly income, but they differ in structure, risk profile, and sources of return. These distinctions make a significant impact on their long-term performance and income growth potential. All right, let's talk about the part that everyone loves, the dividends. Right now, all three funds are offering some pretty eye-catching yields. Leading the pack is QQQI, sitting at a hefty 13.38%. That's one of the highest you'll find in the dividend ETF world, and it's powered by its tech-heavy lineup and covered call strategy that squeezes a little more cash out of every share. Right behind it is SPYI with an 11.62% yield. It's slightly lower than QQQI's, but still impressive, especially considering it's built on the S&P 500, one of the most diversified and battle-tested indexes around. Its covered call approach adds an extra layer of income on top of those blue-chip dividends, giving you both stability and a healthy cash flow. Then there's OMAH, offering an 8.79% yield. It might look modest compared to the others, but it earns that income through a mix of traditional dividends and a Berkshire-inspired covered call strategy. Instead of chasing volatility, OMAH focuses on reliable, high-quality companies and uses options conservatively to boost income without taking wild bets. All three ETFs pay monthly, which is great for passive income. That steady stream can be a lifesaver if you're budgeting for retirement, bills, or simply reinvesting every month. Now, these ETFs are relatively new, and only SPYI has a history of more than a year, during which it's shown dividend growth with a 10-year CAGR of 1.41%. QQQI and OMAH don't report dividend growth yet, and that's not because they're weak funds, it's simply because they're too new. They haven't existed long enough to build a reliable dividend growth track record. So sure, QQQI wins on raw yield, but SPYI brings balance and growth, and OMAH is your slow, steady dividend traditionalist with a slightly modern take. When we talk about high dividend ETFs, everyone's first question is how much does it pay? But the smarter question is how much does it grow? Because real wealth doesn't just come from income, it comes from total return, that perfect mix of steady cash flow and rising share price, or in the case of income ETFs, stable prices. So what do the latest numbers show? Since its inception, SPYI gained about 8.1%. QQQI came in a close second at 7.8%, and OMAH dipped slightly at negative 3.36%. And before you judge those numbers too quickly, remember, all three ETFs are relatively new. There isn't enough long-term data yet for clean 3- or 5-year averages, so comparing the most recent year keeps things fair across the board. For QQQI, that combination of solid growth and double-digit yield is pretty rare. Its performance is powered by its tech-heavy lineup, the same giants driving the Nasdaq's success: NVIDIA, Microsoft, Meta, and Apple. When you're collecting a 13% yield and reinvesting into a fund that's also growing, you're essentially compounding on two fronts. It's bold, it's fast-moving, and it's designed for investors who can handle a little more volatility in exchange for bigger potential rewards. SPYI, on the other hand, tells a steadier story. With roughly 8% growth and an 11.6% yield, it delivers a smoother ride thanks to its broad S&P 500 base. It's not the kind of ETF that explodes in one year, but it wins through reliability. Think of it as the slow-cooked version of wealth building. It takes its time, but the results are consistent, dependable, and slow-cooked delicious. And then there's OMAH, which plays by a different set of rules. Its short-term dip of about 3% can look disappointing at first look, but this fund isn't built for quick gains. Its portfolio leans toward financials, consumer staples, and steady value stocks, not high-octane tech. The goal here is predictable income, not price action. That's why OMAH's investors focus more on maintaining its 8.79% yield and dependable monthly cash flow than on day-to-day performance. In a couple of minutes, I'm going to show you what type of return you can expect if you invest a one-time sum of $100,000 into these ETFs over the next 1, 5, and 10 years. And in the end, I'll show you a winner that can turn this $100,000 into a $500,000 portfolio that pays over $2,800 in monthly dividend income. But first, let's say you're ready to put $100,000 into one of these ETFs, or maybe even more. That's when you have to stop and ask, how easy is it to get in and out? That's where liquidity comes in. Liquidity just means how quickly and efficiently you can trade a stock or ETF without affecting its price too much. More liquidity means tighter spreads, faster execution, and fewer surprises when you're buying or selling. Starting with OMAH, it's the smallest of the three and trades about 713,000 shares per day. Because its share price sits around $19, that's roughly $14 million in daily trading volume. Not bad, but definitely thinner compared to larger funds. Its $610 million in assets makes it a healthy mid-sized ETF, but big trades might take a little more patience or slightly wider bid-ask spreads. Next up is SPYI, which is far more liquid. It moves about 2.3 million shares daily with a dollar volume near 120 million. Add to that more than $5.8 billion in assets, and you've got a fund that's large, active, and easy to trade whether you're investing a few thousand or a few million. And then there's QQQI, the volume leader of the group. It trades around 3.7 million shares per day with roughly $200 million in daily dollar volume. That's a lot of action, which means you can enter or exit large positions without worrying about big price swings. Now, lower liquidity doesn't make a fund bad. It just means trades might take a little more patience, especially when markets get choppy. For long-term investors who plan to hold and reinvest, it's rarely a deal breaker. But if flexibility matters, or you like the option to trade larger amounts smoothly, SPYI and QQQI have the clear advantage here. And liquidity ties directly into something equally important: how concentrated or diversified each ETF really is. Because how many companies you own and how heavily you lean on the top few can make a huge difference in both returns and risk. The more concentrated a fund is, the bigger your wins and losses can be when those few names move. OMAH, the most focused of the three, holds only about 70 stocks, and a massive 60% of the fund sits in its top 10 positions. That means more than half of your money is really riding on companies like Apple, Berkshire Hathaway, and American Express. It's a bold, Buffett-style strategy built on conviction. When those companies perform, the results can be fantastic, but it also makes the portfolio more sensitive. SPYI, on the other hand, takes the complete opposite approach. With over 500 holdings and just 39% in its top 10, it's easily the most diversified. Its low turnover rate, around 2%, means it barely changes its lineup, which helps reduce trading costs and keeps performance steady. SPYI is built for predictability, a buy it, hold it, and let it grow kind of ETF. Then there's QQQI, which sits somewhere in between. It owns about 100 stocks, but over 50% of its value still sits in its top 10, names like Nvidia, Microsoft, Apple, and Meta. With a 22% turnover rate, it's more active, adjusting positions more frequently to capture tech-driven trends. That flexibility can boost returns during strong markets, but it can also make the ride a little bumpier. So here's the trade-off. OMAH and QQQI lean into concentration, which can deliver bigger payoffs and total returns, but also bigger pullbacks. Meanwhile, SPYI spreads things out, giving you smoother compounding and fewer surprises. It really comes down to what kind of investor you are. Do you prefer steady and balanced, or focused and fast-moving? Now, let's turn this structure into numbers and see exactly how $100,000 could grow in each of these ETFs over time. To keep things simple, let's assume you invest once, no additional contributions, and reinvest all of your dividends. I'll show you and John how that $100,000 could grow over 1, 5, and 10 years in SPYI, QQQI, and OMAH. Let's start with OMAH. It currently yields about 8.79% with no measurable dividend growth yet and a negative 3.36% average annual price movement. Based on these metrics, after 1 year, an initial investment of $100,000 is projected to be valued at $105,430. Total dividends earned will be about $8,790 or $733 per month, with an estimated negative $3,360 in capital depreciation. After 5 years, the portfolio is expected to be valued at $134,075. Total reinvested dividends will reach $52,917. Capital depreciation will amount to negative $18,842, and annual income will rise to around $12,609 or $1,051 per month. After 10 years, the portfolio value is projected to reach $194,538. Reinvested dividends will total $139,482, capital depreciation will be approximately negative $44,944, and annual income is expected to grow to $21,225 or about $1,769 per month. Total projected growth after 10 years, $94,538, primarily driven by reinvested dividends rather than price appreciation. Next, let's look at SPYI, which builds on a broader base of companies and adds moderate growth to that steady income stream. SPYI has a dividend yield of 11.62%, a dividend growth rate of 1.41%, and an average annual share price appreciation of 1.91%. After 1 year, an initial investment of $100,000 in this ETF is projected to be around $113,530. Total dividends earned will be $11,620 or $968 per month. After 5 years, the portfolio will be valued at $187,646. Reinvested dividends will total $75,153, capital appreciation will amount to $12,493, and annual income will rise to $18,863 or $1,572 per month. After 10 years, the portfolio value will reach $347,713. Reinvested dividends will total $211,911. Capital appreciation will be $35,803, and annual income will grow to $34,174 or about $2,848 per month. Total projected growth after 10 years, $247,713, primarily driven by dividend reinvestment and consistent income compounding. Next, we'll look at QQQI, which adds higher volatility and faster potential growth to the mix. QQQI has a dividend yield of 13.38% and an average annual share price appreciation of 7.8%, the strongest share price growth potential among the 3 ETFs. After 1 year, an initial investment of $100,000 in this ETF will be valued at $121,180. Total dividends earned will be $13,380 or $1,115 per month, with $7,800 in capital appreciation. After 5 years, the portfolio will be valued at $241,072. After 10 years, the portfolio value will reach nearly $500,000, reaching $493,910. Reinvested dividends will total $206,450, capital appreciation will be $187,460, and annual income will grow to $27,852 or about $2,321 per month. Total projected growth after 10 years, $393,910, driven by a strong combination of dividend reinvestment and price appreciation. So let's pull everything together and see how these 3 ETFs stack up side by side. In terms of dividend income, OMAH starts lower at $8,790 but grows slowly to $21,225 over 10 years. Slow, steady, and built on dependable income rather than price gains. SPYI shows stronger compounding, rising from $11,620 to $34,174, fueled by its higher yield and balanced growth approach. Meanwhile, QQQI begins with the highest payout at $13,380 and climbs to $27,852, offering solid growth with a bit more volatility along the way. Looking at total portfolio value tells an even clearer story. OMAH begins at $105,430, reaches $134,075 after 5 years, and grows to $194,538 after 10 years. Stable, predictable progress, driven mostly by reinvested dividends. SPYI starts at $113,530, grows to $187,646 in 5 years, and reaches $347,713 after 10. QQQI leads the pack, beginning at $121,180, jumping to $241,072 after 5 years, and surging to $493,910 by year 10, a steep, tech-powered climb that comes with higher potential and higher swings. All three have distinct personalities. OMAH focuses on income stability and conservative growth. SPYI blends strong yield with broad diversification for steady long-term compounding. QQQI targets fast total return through higher risk and stronger tech exposure. Want to know how to make $4,000 a month with only a $12 weekly investment? Click the video on the screen to find out.